The S&P 500 was just 1% away from all-time highs before a geopolitical event rocked the news cycle and rocked the world late last week. I'm obviously talking about Israel attacking Iran. Now, it seemed like the market pulled back on Friday last week and we got a 1% drop, but obviously people are worried on whether this means that the market will pull back further. If you remember, I shared with you last week that we were coming into this daily fair value gap here on the S&P 500 and that I would not be surprised to see a pullback to that gap between May 9th and May 12th. This had nothing to do with the attack when I said that. So what does this mean for your portfolio and your money in the short term? What events should you be looking out for this week? And what opportunities could present themselves here? I'll first talk about the news and the events this week that you should be aware of, and then I'll go through some of the individual ticker names and see whether there are technical opportunities for us to take advantage of. And just as a caveat, I know that this week we have a geopolitical incident involved in the news cycle. This is a financial channel, this is a stock market channel and a trading channel, so I don't want to seem insensitive, but I will be speaking on this from mostly a financial perspective. Those of you who follow me on social media will likely know what I think about this, and I always flirt with the idea of starting a second political channel, but for now we'll stick to the financial takes. So first of all, in order to quell a lot of fears and panic that you might be experiencing or might be hearing, in terms of the stock market, it absolutely does not care about war. It just doesn't. We've seen this time and time again, whether the US is involved directly or indirectly. Now, I won't go as far as saying that the commodities market, oil, gold, the dollar, etc., are not affected by war. Of course they are, but not the stock market, because really the market and its fundamentals are shielded, at least in the United States, are shielded for the most part from these events. So, for instance, do you think that the price of AirPods are going to go up or down because of war? Do you think that Google searches will drop or Waymo usage or Uber usage will go down because of war? No, these things really in America, American companies operate in a silo. Obviously, there are some companies that do have more geopolitical exposure, but most of the mega caps will be fine. And that's why we tend to see not a lot of direct effects from to the US stock market from these wars. There have been times when wars have happened during periods of a recession where the market is going down because of the recession, not because of the war. So even if you take a look at a direct involvement where the US went into war in Iraq in 2003, the market rallied 80% thereafter. Even if you take a look at the worst war in history, World War II, when the US joined the war, it was almost 1942. It was December 1941. And the market rallied like it has never before during that time. Now, you'll see here the war in Afghanistan that was started in 2001. The market was already in a bear market, and we continued that bear market. But around the time of the Iraq war, that was the bottom of the bear market, and we started a bull market. So we were already in a recession and already in a bear market during the Afghanistan war. And the most obvious recent conflict involving a superpower that the world remembers is the Russia-Ukraine conflict in 2022. And that almost bottomed the bear market and we started a bull market thereafter. So these types of wars don't really have that much of an effect on the stock market. Now, in the short term, when we are technically set up for a pullback like this, it could accelerate the news cycle and deliver a fast pullback. But if we go back to 2024, I want you to take a look at how the S&P 500 behaves when it is near all-time highs, not because of geopolitical events, but because of liquidity. I'll explain what I mean in a second. So if you look at December 2024, we almost hit all-time highs before coming into the last daily fair value gap, going down to fill this gap that you see here back in early November, sweeping this liquidity, then getting back to all-time highs. This happened once again in August of 2024. This right here was the all-time high. You have this gap here. We came very close to all-time high, hit that gap, dropped, filled this one here before rallying again to all-time highs. Something very similar here. We have a daily fair value gap. We crawled up towards that, almost hitting all-time highs, but we left this gap open here. There's even one open from April 22nd to April 23rd. Sure, it's possible that we visit that, but let's address what we have in front of us at first, right? So even without this conflict, my base case was that the S&P 500 routinely drops from the last gap right before all-time highs and drops about 4.5%, at least the last couple of times. It did that back in December and back in August. It dropped 4.5% before then conquering all-time highs once again. And it's not surprising that this drop right here would be around 4.5% before potentially going back to conquer all-time highs. So I would not be surprised, and I was not surprised that a pullback started here, conflict or not. We already have a large data set showing that conflicts don't really have that direct of an effect on the stock market. Again, oil, gold, and the dollar different, but we're talking here about the stock market. So I would not be surprised to see this pullback here. We might not even get it, but I would not be surprised to see this pullback here. And as I told you last week before the conflict, that this would be a welcomed gift and provide us with a lot of buy the dip opportunities on stocks that have ran up so violently, like Meta, for instance, or a stock that I gave you guys on this channel, SOXL. We bought this at 7. Currently trading at 20. We still have a gap here between May 9th and May 12th. Would be a gift to get back into cheap SOXL shares. This is the semiconductor ETF, of course. Now, we'll get back to the markets and the charts, but what should you be watching out for this week? It is a huge week in the stock market, even though it is a shortened week because of Juneteenth on Thursday. But we have retail sales on Tuesday. On Wednesday, we have unemployment claims. More importantly, we have the FOMC meeting, the Fed meeting on June 18th. Is the Fed going to cut rates, or are they going to keep rates steady? If we take a look at the Fed funds futures, 97% chance that the Fed is going to keep rates steady. Now, I thought that before this current geopolitical conflict between Iran and Israel, that the Fed was not going to cut rates. And now for sure, I think the Fed is not going to cut rates because a surge in oil prices, which we will see, is potentially inflationary. And if that's the case, then obviously the Fed is not going to cut. Plus, jobs numbers continue to impress or at least satisfy the Fed's baseline. To make matters worse, this is going to be a volatile week by nature because it is VIX-piration week. We have VIX monthly options expiring June 18th. We tend to see a ton of volatility surrounding this. So I'll be very curious to see any geopolitical updates, what implications that has for the VIX, especially surrounding VIX-piration. If there is a spike in volatility, it could be even more accelerated by the fact that geopolitical events are ramping up. Now, this is the latest news. Obviously, this can change. But according to Axios, it says that Trump says that Israel and Iran should make a deal to end the war, and that the U.S. is not looking to enter the war. But obviously, in Trump fashion, he left the doors open for any possibility, saying on Sunday, today, as of the time of this recording, that it's possible we could get involved. And here we have a report by an Israeli agency called Haaretz saying that Netanyahu is counting on Trump to finish what Israel started in Iran. So like I said, in the broader term, while I don't think that this is going to have a big impact on the stock market, in the short term, it could have an impact on volatility, oil prices, the dollar, gold, etc. And it could accelerate a pullback in the S&P 500 to that level that I was talking about. Now, some more data with regards to the S&P 500 during this time period. This also coincides with a very seasonal pattern that we see here. So the period of June 19th to June 26th, which is this week coming up as of the time of this recording, when the trailing 12 months up until this point is positive, and it is now. So the trailing 12 months a year ago to today is plus 10% on the S&P 500. The years that has been positive, and more importantly, the years that has been positive in double-digit fashion, we tend to see a pullback during the week of June 19th to June 26th. If I combine the seasonality with these technicals and we overlay that with the potential geopolitical implications as well, then it would actually fall in line with that seasonality where we tend to see a drop or a pullback this week. Now, in terms of opportunities, what stocks are there to buy, or what positions can we take in this market here based on what we know? I think that at this point, although I'm still bullish on the market for the rest of the year, like I said, I do think that we will see a potential pullback. Now, This is the perfect opportunity from a technical and from a fundamental standpoint for that to happen. But we don't know for sure, obviously. Come Monday, if we do get another day of red, then I do think that it's very plausible that the indices revisit that May 9th to May 12th gap. Now, this right here is the NASDAQ. I think that the NASDAQ or QQQ is a lot cleaner, plus it moves in a more accelerated fashion. So if you are going to hedge here by buying QQQ puts or buying SQQQ ETF, that right there on QQQ would be my target. You could see here this rising wedge, we already broke out of it. And you could see here if I overlay the 100 and 200 day SMAs here, a drop to that level is definitely not out of line, especially with all the things that I considered, including seasonality, including the technical patterns that typically occurs at all-time highs. And now you have the short-term geopolitical impetus, the fact that VIX expiration is this week as well, and we tend to see a spike in volatility, added volatility because of that. If you want to trade live with me every day, every single morning, I day trade futures and go over potential options plays as well. Link is in the description below. If you are just a long-term investor, there is a more affordable option at just $35 a month at the moment, I think. So click the link below, come trade with me. Would love to have you. Now, before I jump into another play, I said that I would explain why this typically happens near all-time highs. One of the things that I think people misunderstand is the concept of liquidity in the market. So as we get near all-time highs, this right here is already a psychological ceiling. This is a perceived ceiling because it is the established all-time high. So once we get near that level, buying volume starts to thin out because there is very little upside if someone is buying right near what they perceive to be the ceiling. And if there are these imbalances here, this gap, for instance, or this gap, there are a lot of buyers waiting for entry into the market at those levels. And if buying volume up here starts to thin out and sellers finally take over, when sellers take over, that will likely cause a short-term panic and accelerated selling from this level. And we will likely find support at these gaps or these imbalances that exist in the market that have not yet been addressed. So it's not just the indices that have these imbalances. If you take a look at NVIDIA, for example, right, it has a ton of these gaps here. We haven't touched the 21 EMA in almost 2 months on NVIDIA. This is why I said that a pullback, even before the conflict, would present an opportunity to re-add or add more of this stuff to your long-term portfolio. And for those of you that swing trade, present us with an opportunity to potentially leverage options or leaps in the short term in order to make money from the move back up, because I am still bullish to round out the year. Now on short-term holdings like SOXL, because it's a leverage ETF, this is a short-term holding. This is the type of short-term holding that I would likely take profits on in this scenario for a potential to re-enter if we get a drop in price, right? If we take a look at the SOXX ETF, which that SOXL ETF is based on, this one I own in my long-term portfolio, but you could see here, even after the 2022 bear market, once we started recovering, you could see these typical pullbacks here on the weekly chart. We haven't had one yet on this ETF, and there is that gap from May 9th to May 12th on the weekly chart. I would not be surprised to see a pullback here, and I would actually favor a pullback here. I think it is much more healthy if you want to see the stock go a lot higher within the next year. So I will be monitoring SOXX to add more SOXL or re-add SOXL back to the portfolio once this gap is filled. Same story with Meta, which I think is one of the strongest names because it doesn't have tariff implications. It doesn't have geostrategic implications. And it is making money. It's one of the few companies that is currently making money off AI. And you can see here that it has a gap also between May 9th and May 12th at around the 600 to 630 level. This is a stock that I'm looking to add more of. In my view, it's going back to all-time highs without a doubt. These companies, Google, Meta, Amazon, they are a lot stronger now than they were at their all-time highs that we saw in February of 2025. And Tesla, I think here is in an interesting spot. So we traded Tesla, still hold calls on Tesla, traded it on Friday as well with short-term calls, was able to net 30%, was one of the few green stocks last Friday when the market was pulling back a little bit and had an over -1% day. Tesla was actually up 2% on the day. And that is because it is bouncing off of the Trump versus Elon candle here that you see from June 5th, right? This was the panic fear when it looked like Elon and Trump were at odds, which obviously would make Tesla's life a lot harder since they rely on government deregulation in order to fast track full self-driving. But you can see that we're bouncing off of this candle. And I think that if for instance, there is a spike in oil prices, that obviously makes the case for EVs, at least from a perception standpoint, makes the case for EVs a lot stronger, because when oil prices go up, obviously people tend to gravitate to EVs and hybrids. Again, Tesla doesn't have geopolitical risk, and also it has a big event looming, which is the Robotaxi Cybercab event. Not really a singular event. I talked about it in my last video. More of a month-long rollout. But if that continues to go well, then obviously that opens the doors to a very new business model for Tesla that doesn't just rely on vehicles, but also relies on robotics and AI, as well as self-driving and ride sharing. So unless Tesla closes below that 300 level, I'm still bullish on Tesla regardless of what is happening here in the short term. If you compare the indices in Tesla, if you look at the S&P 500, it bottomed at around April 7th and just had a violent rally thereafter. If you remember, it took Tesla quite a while for this to happen. Tesla didn't really bottom until a month later before it had its rally. So while the rest of the market was rallying, Tesla was here in a lull. So I personally would not be surprised to see Tesla rally from here, or at least not drop as much relative to the market if we do see a market drop. Now, I do think that there will be another opportunity to short the VIX. I would not short the VIX this week before VIXpiration, in my opinion. But I do think that Trump still is looking for a more peaceful resolution to this conflict and is not looking to escalate this conflict. Obviously, everything's possible. As he said, the U.S. could get involved if it gets worse. But what we see with these wartime VIX spikes is after, we saw this with Russia and Ukraine as well, right? Russia and Ukraine continued to persist, and then the VIX obviously died back down and continue trading at its normal levels. I think a similar thing will happen here, but I'm not going to be crazy enough to short the VIX this early just yet. Obviously, this is going to be very news dependent and will be more speculative, but I do think that the higher the VIX goes, the more optimal a short opportunity will get. And the same goes for oil futures as well. Oil hit almost $77 a barrel. Did retrace a bit down to 73, but this is another name that I'm looking for a potential opportunity in here, because obviously when there are overreactions or big spikes or big drops, those types of events should really put your radars and your antennas up that there may be an opportunity to take advantage of a counter trade, since it is seen as a reactionary event. Let me know in the comment section below, what opportunities are you looking for in this market here, in this market environment? Do you think we'll see a big drop? Are you getting your cash ready to enter the market if you've been sitting on the sidelines? Are you completely out of the market and you're saying, F this, I don't want to be a part of this? Let me know in the comment section below. Would love to hear from you. If you want to trade live with me every single morning at market open, link is in the description below. Like I said, there's a much more affordable tier down below, $35 a month. If you are just a long-term investor and want the long-term analysis, subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.